where we'll tackle the topic of how to spend a few minutes with your customers' income statements to create an ongoing flow of new revenue opportunities. Sharing an approach for doing so, we welcome back an individual who's prepared a great number of income statements in his career, Chairman and co-founder of Executive Conversation, Jim Melillo. Jim brings a broad experience from a CFO perspective with both public and private companies in both corporate development and treasury. Let me quickly share a few logistical details, and I'll turn it over to Jim. We'll run about 30 minutes for this presentation, at the end of which we'll ask for your questions. When questions arise during presentation, please feel free to enter those in the Q&A box on your screen. We'll also have a few polling questions during this presentation and encourage your participation. Jim, without further ado, let me turn this over to you.
Eric and everyone, thanks so very much. Again, an amazing turnout, 100 people already online 15 minutes before, over 830 registrations. Thanks so very much for coming. And today's topic is, as you saw on the slide, the 10-minute income statement. I'm hoping you invest more than 10 minutes in your customer and their financials, but if you need to get a quick look, if you need to take a look at what are the big ideas, and it's going to vary by industry, we're going to go through it. As we always do, we kick off everything with the poll just to see where the groups have. We've got, looks like over 400 people so far. Which of the following is true about the income statement? And remember, you only get 30 seconds to answer. 1, A, banks and manufacturers use the same format. B, tells whether a company is growing or not. C, it's useful for projecting a company's cash flow. D, provides insight into customer buy or lease preferences. A little tougher question than normal, so let's take the 30 seconds. Let's see if we can't get 200 or 300 people to vote. We've got 15 seconds left. And now we have 10. What we're looking for is where you sit right now on income statements, and more importantly, you should be voting for the simple reason is it gives you an insight into where you're voting and what you understand. Good. We've closed the poll. As we tabulate it, we're going to take a look and see where we want to go. So, sharing poll results, what numbers do we have here?
Boy, almost a dead heat between answers B and C. Tells whether a company is growing or not at 45%. Useful for projecting cash flow at 41%. Well in arrears, we have the first two, banks and manufacturers, using the same format, as well as the buy lease preference option.
Fantastic. Well, congratulations to the 45% of the people that got it correct. Banks and manufacturers use radically different income statements. Cash flow is actually a third statement that we would prepare in the finance group for publicly held firms. Buy and lease, you know what you really need to go is to the notes of the income statement, notes of the balance sheet, or the balance sheet itself. And so it tells us whether a company is growing or not, right on the money. The income statement is looked at over time. And as you take a look at all the companies that are on, and the list has changed a bit, one, we've had more companies join us, and second of all, we have recognized those people that sent in emails and said, how come my name's not up there? Pretty astonishing the breadth of people that are interested in this topic, all the way from technology providers down to financial services, shipping, and even we have European airplane manufacturers. And so the question is, what is the value of the 10-minute income statement? Well, the value is that you need to, on a personal level, reduce your time to insight. And I fully understand that you're extremely busy. And you may have 20, 50, 100 down my year. Remember, an income statement only for this year, a balance since the company was founded in 1649. So as you look at the balance sheet, theoretically you can find Plymouth Rock. You look at the income statement, it's just what went on this year. In addition, it allows you, particularly when you look at 3 years, not 2, make sure you get 3, to really see where I'm moving my business. If you want to break this down, if you want to find out which portion of your account is go out to the section called the segment analysis. The segment analysis takes your account and breaks it down into their Brazilian operation, their U.S. operation, their European operation. Or it'll break it down into the portion of the business making doors, the portion of the business making windows, and the portion of the business making washing machines. So again, income statement and then the segment analysis gives you a great idea of what's going on. Cutting back, which group of those three is doing worse? Is it windows? Is it doors? Is it washing machine? The story behind the numbers becomes critical for you to understand. After all, I look at income statements and I can tell you when an acquisition happened. I can tell you when they did layoffs. I can tell you when the group decided to change its go-to-market strategy. Let's take a look if you feel that way after we're done. First thing I mentioned, horizontally, you want to do this over a 3-year period. But vertically, compared to sales. So vertically, you look at everything compared to sales. So I start off with sales or revenue, and then what is my cost of goods compared to sales? What is my selling, my marketing, my general, my administrative, my earnings before interest and income tax compared to sales? And so we want to look at things across 3 years and then vertically. Some people like to look at them compared to other companies, but I think for a quick look, you'd spend too much time looking all that information up. Let's take a look at a company that's doing quite well. You have your account. Sales are growing 8%. Look, in a 2 or 3% growth economy, that's phenomenal. Growth of high margin revenue, 2%. That's nice. They've introduced their new products. Traditional products grew at 16%, 0% outside the U.S. Inventory levels seem to be growing a little bit faster, 12% versus average growth. Not a bad company until we move to a more complex analysis. And if you have the time, you now have the ability to look at my vertical, my horizontal, and now that key competitor. So when you get the time, let's take a look at what you look like compared to the key competitor. Grew 8%, competitors growing at 14, industries growing at 11. That's serious. In addition, when I begin to take a look at where the competitors and the industry are growing, I begin to see that my internal growth of high margin and non-U.S. products is lagging the industry. So we now have vertical, horizontal within the company, and if you have time, we can do a key competitor analysis. Now, I've got the income statement in front of me, and what I want to do is look at the bottom line, the net. Is it in money or is it a loss? Nope. You know what? The biggest mistake everybody says to me is, Jim, look at that bottom line. Look at their profits. The answer is profits mean nothing. That's right. Profits mean nothing. Why? Because profits are nothing more than a function of what occurred on every other line. You can't change profits. You have to change every other line that gets to profits. So don't look at the bottom line. Don't look at their net profit and how it's changed over time. First of all, if any profit line you're going to look at operating profit. But more importantly, let's focus on the top line. We're going to start with the top line. We're going to start with what does it look like? Here it is. Year 1 did 600 million. Year 2 did 800 million. How's sales and revenue doing? Looking great. So the first thing you look at is your revenue line. Over 3 years, you can get a pretty good idea. Now what we have is the view on sales. What should I do? If sales are trending down, what should you be thinking about? Well, you're probably looking at 3 years worth of downward trending sales. You're probably going to want to go to the cost lines very quickly. Those cost or expense lines are what I'm focused on, since I obviously can't fix sales. Gee, Jim, 3 years of downward sloping sales, shouldn't I be going after the sales line? Absolutely, if you feel you have a sales-oriented solution. As a matter of fact, in previous webinars, what we've talked about is this is the time for sales growth. The world is looking down the face of a second recession. We already have negative numbers coming out of Europe for GDP growth. Brazil has dropped from 8% down to 2 or 3. China has dropped from 9 to 6. And so what we're looking at is everybody wants to get their revenue going again. So if you have a downward sloping sales line, the easy money, go after costs. If you want to align with my future, talk to me about how you've helped other companies turn around sales. So now we come to how. Nobody in the world ever made money telling a customer, I'm here to increase your revenue. As those of you who have heard me make the sound before, duh, how many people have ever in their life walked into their client, let's show of hands, okay? How many people walked into their client and said, I'm here to reduce your revenue, drive it through the basement? Well, if nobody's ever said that, how smart do you think it sounds when you say the opposite? I'm here to grow revenue. Everybody tells me that. Specifically, how? Hi, Jim, I'm here to help you increase your average revenue per user, your deal size. How? What we can do is we can add value-added services. We can add data. We can add digital. We can add windows with that door. Jim, you know what? We're here to help you in your business add fee income. Basically, you have sold product. Now we're going to build a consulting or a fee-based. You know, Jim, we're going to reduce the time to market, which allows you to take market share and get there quicker. Any of those specifics are how you drive revenue. After revenue, then you have various other things to look at. Revenue minus cost of manufacturing, whether it's a door, piece of technology, or pharmaceutical, gets you to gross profit. We'll talk about these. And then operating expenses gets you to operating income. This is where your impact stops. You cannot do anything down here unless you're from an accounting firm or a tax mitigation firm. For those of you that are working with financial services, they have a funny income statement, but let me walk you through it quickly. They have revenue, except that they call it interest income and non-interest income. And then they subtract their interest expense, the cost of getting money, and it's called net interest income. Then, like every other company, they have expenses to get to operating income. And again, this is where your analysis stops. So regardless of whether you're working with a manufacturing company or whether you're working with a bank, you want to talk about the things between the top line and operating income. What's the next line down? The next line down is gross profit. And we get that by increasing or decreasing the cost of goods. And so we had 600,000 growing to 600 million growing to $800 million of revenue. And then we had a cost of goods, 250 growing to 300. Sounds like this company is on the right track. And sure enough, we see that gross profit has grown from 350 to 500, but more importantly, and this is what we look at, more importantly, the percentage has gone up. Oh, it went down. Gross profit is up 150, but as a percentage of sales, it's down 5. That's the story right there. No, it didn't go up. Wow, Jim, you grew your revenue from 600 to 800, and your sales, your cost of goods only went from 250 to 300. Things must be doing great. Yes, gross profit went up, but the percentage went down, and that's what we look at. As a matter of fact, most companies look at that percentage in terms of hundredths of 1%, called basis points, BIPs. And so people will say, we had a great quarter, we increased gross profit 30 basis points. That means they increased gross profit 0.003. And they're excited. What was the issue? What causes your customers' costs to go up? Or were they discounting more? More importantly, how do you link to this? Gross profit. Why focus on it? Well, as you can see, not only is it an important number, but everything gets paid from gross profit. Your sales commission, your marketing, your finance people, your corporate headquarters, the research and development that goes into your business, the IT department, all of that gets paid out of gross margin. or gross profit. And that is the biggest impact you can have. And so when you begin to take a look at that 5% drop, what caused it? Was it labor? Was it quality and returns? Was it old technology? We want to know, A, that you understand it, and then B, how do you change it? How do you change that gross margin? How do you get it back up to 42%? Well, there are a lot of things you can knock after. You can knock on material costs. We can help you reduce scrap. Jim, what we can do is we can help you with a product mix where you can sell the product using less materials. We can help you reduce your service or your labor. We can help you get to market quicker, thus getting a higher sales price than the cost of manufacturing it. It's no coincidence that every fall a new Apple handset comes out and every spring a new iPad comes out, for the simple reason that it allows me to maintain that same price to manufacture, about $190, and yet I'm able to increase the price back up to that $699, $799, $899. My gross profit is much higher when I get you to buy the iPad 3 at $899 than it is the iPad 2 at $495. Relatively little difference. How do you help me reduce my time to market? You know, I've used two terms here. One is gross profit and one is gross margin. Now we're going to take a poll. What's the difference? A, different ways of saying the same thing. Gross profit, gross margin. Gross margin excludes cost of goods sold. Gross margin is gross profit as a percentage. Gross margin recognizes time value of money. So what's the difference between the words gross profit and gross margin that I've just used? Again, 30 seconds to talk about it, come up with an answer. Let's put it in there. No cheating, no looking at your friend's paper. Come on, put the number in. 10 seconds to go. What we want to do is how do we understand these terms and then how do we change them? So let's close the poll up. Let's take a look at what we've got here and let's see what your thoughts were. So, Eric, what do you have for the number 1 and 2 answer?
A very strong response from the audience here, picking gross margin as gross profit recognized as a percentage at 53%. So that was clearly the winner. Answer A, 17%. Answer B, 22%. And lastly, the time value of money of response at 8%.
Congratulations to the 50-plus percentage that got. Gross margin is a percentage. So revenue minus cost of goods gets me a gross profit. When I divide gross profit by revenue, bingo, I got a percentage, 37, 42, and that's my gross margin. Fantastic. You know, we've been asking a lot of questions here, and recently for those of you, and God, we've had thousands of people come to the new website. Recently, what we've done is we have given you the opportunity to begin to take a look at where you should be, and we call it the benchmark tool. So if you go to our website, click on benchmark tool, it gives you an idea of, you know, Jim, I'm more in a commercial role. I've got several hundred accounts. What should I know? Gee, Jim, I'm an enterprise person. What should I know? You know, I've got a global responsibility. Where should I rank? So again, as we go through all these webinars and we begin to develop these skill sets over here, take a look at what well in excess of 25,000 people have done and where do you stand compared to that. So just go to conversation.com, click on the benchmark tool. And as you begin to continue to learn about this, we go from sales grew 6 to 8, cost of goods, hey, don't trick me again. I know that margin slipped a little on a percentage basis. And we know that sales and marketing went up. We know that G&A was held pretty tight. So what is happening with this company? Well, on a quick basis, we know that they lost 5 points here, and now they've lost 4 points here. Those sales and marketing costs are going up. Gross profit is going down as a percentage, gross margin. And this company is in deep trouble. As a matter of fact, if you do the math in your head, you'll see that they made 100 on 600 in year one, and they're making 145 on 800 in year two. Things continue to get worse. What will you do about this? 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 For those of you not watching this on a video but listening to it on cell phones or on landlines, what I just said was, we've got 5 items up here. What are you going to do about it? How are you going to affect my operating costs? How do you help me sell more with the same sales and marketing load? How do you help me have research and development on a global basis turn out more inventions? How do you help me reduce my overhead, traditionally called general and administrative? What line item do you go after? Then, given that, why is it going bad, and what can you do? Look, there's no reason for me ever to buy anything from you if you can't show me what's wrong now and what could be better after your solution. There's no reason for me to ever make an investment in your product, in switching to your supplies, in undertaking your services, unless you can show me how the current situation stinks. Maybe it stinks compared to the way I run my business. Maybe it's subpar compared to my competitors. But you know what? I'm in the middle of it. And many times it's hard for me to understand that. You've got to take the current situation and show me how better looks. One of the reasons why your toughest competitor is always do not buy, do nothing, is because I don't see a clear avenue to what that better looks like, what that change looks like, what the promised land looks like. And you know what? We have to go through someone. We go through a solution, and that might be you. If you can show me specifically how we take our sales and marketing costs and move those to a better relationship to sales, how you show me how research and development brings products to market quicker, how you show me how you can help me control my general administrative, how you can help me change my client infrastructure, which affects my operating profit, now I want to give you money. Now I want to invest in you. I know this is difficult, and I know we're going fast. By the way, this is being recorded, and you can get it on the website along with the others. But more importantly, thinking about today, what are you doing to have this conversation? You're going to leave a voicemail for a client in the next 2 hours, 6 hours. You're going to go meet a customer in the next 2 days, 10 days. How are you going to change your relationship to that client? You've got to change it through the income statement. You've got to be knowledgeable. A lot of you, hundreds, have already signed up for the LinkedIn where we run a lot of these blogs, where we share a lot of this. Feel free to take a look at that and become a member. But the specifics are, how do you change my life? As I've told people before, in my life, I have done 3 major information technology changes. I have helped build 2.5 factories, one in Athlone, Ireland, one in Puerto Rico, and fixing one in the U.S. How many customers have you sold to in your life? 10, 50, 100, 500? What specifically did you do that affected their revenue? What did specifically you do to improve their gross margin? How did you reduce the specific operating costs? When you have that discussion with me, when you can show me what it looks like on the other side, when you can show me what that promised land looks like, wow, I want to work with you. I not only want to work with you, I want to make you a partner. We don't use that term a whole lot because, to be honest with you, most people don't earn the right to be a partner. A partner is about having that conversation with me because you focus on the specifics of the income statement. As you move forward today, the rest of your day, take a look at your conversations with your direct reports. Do you open up your sales conferences every Monday morning with what is the opportunity here, where are we with, or do you open them up with challenging your people with what is the opportunity here, and where is the income going to be on the income statement? You know, when you have that conversation, you're having amazing changes to the way you work with me. And that is what's so important. That is what is so critical, is how you approach me and how I perceive you. Eric, I'm going to open it up to questions. As always, we usually have more questions than we have time. Tried to end it around 3 minutes early. Do you have any we should cover?
Jim, thank you again for an excellent presentation. And again, we do have quite a plethora of questions here. I'm going to group a number of these that came in similarly. First, around the nuances in industry-specific reporting. We had a number around banks, financial services. Obviously, across countries, that sector has had a lot of challenge. Anything specific when reviewing a bank's financial statements, income statements, and others that you would look for in terms of spotting opportunities?
Sure, there are two very specific things. One is the vast majority of financial organizations around the world have shifted from lending money, interest income minus interest expense, interest income, how I sell money, interest expense, what the cost of my money is, to moving into a business where fee income has become one of the critical components. Do they sell insurance? Do they have origination fees for mortgages? Do they have ATM fees? Growing that business for many banks has become one of the critical ways for them to be successful. Much less risk, and in addition to that, gets them into other businesses. The second portion is take a look at the expense categories, because they're broken out into not departments so much as personnel, cost of facilities, equipment costs. And you can really actually hone in on very specific things around: do they lease, do they buy, are they growing the number of people versus growing the amount of service they offer. So I would say look at fees and then look at those specific category expenses versus those grouped sales, marketing, G&A, which we're normally used to seeing.
Another grouping of questions pertain to the healthcare sector, and questions around the income statements that I'm seeing with clientele in that sector didn't really match up with either the manufacturer or the financial services statements that we shared, looking at the gross profit, gross margin issues. What are the differences, or how do you read the story behind the numbers with organizations in that space?
Sure. I see people from Lawson, GE Healthcare, and quite a few others. Baxter was up there. When you work with a healthcare provider, they have a very old mindset on how an income statement looks like, but the nice thing about it is that they group their expenses very specifically. And so they will show an item called rent. They'll show an item called maintenance. They'll show an item called salaries. Then they'll show benefits. So what this gives you an opportunity to do is to delve closer into what it takes in order to change their business. And you can focus all the way down into the rental category. In a public or privately held company in manufacturing and in IT and whatever, you'll never find what the rent costs are, or they call it occupancy. Here you get an opportunity to look at that. The nice thing also is the vast majority of healthcare providers are private, non-for-profit, and thus you can go and get that information off the form called the 990. In some future episode, we'll have a discussion around using and finding 990s and how to go after them. But for those of you that have the information, what a great opportunity to, you can literally go all the way down into how much are they paying for pension costs. And you can find out what their relationship is to that category versus others.
Jim, another grouping of questions around my portfolio also includes a number of privately held companies. What do I do in those situations to get my hands on an income statement or otherwise get you to open up a little bit?
Sure. First one, if you have a not-for-profit, you can use a service called GuideStar.org, or you can go and get muni bonds. The second one is, if you have an organization that is somehow related to a government agency. In other words, the town has raised money in order to put a facility in, or the county or the state has given them a development bond to move their factory there, go to the muni bonds and take a look at the municipal bond offerings that are being done. The third thing is take a publicly held company, if you don't have those two, take a look at how it lines up and begin building a series of questions that you would normally ask the publicly held competitor to the privately held one. You know, we see the external factors going on in the industry, list the ones for the publicly held company, and then turn to the executive at the privately held one and say, given that, how does that match up with your view of the external factors? So basically, take that public company, learn about it, create your set of questions as if you were talking to them, roll them over to the private company, and use that transparency as a way of getting insight.
We are at the top of the hour, but still a ton of folks on. We'll take a couple last set of questions here. One kind of interesting one, research and development. Isn't that a positive thing? Don't you want to see that going up? Your thoughts on that, Jim?
Yeah. You know, you would love to see it going up, but the reality of R&D is that R&D is no longer R&D. R&D is a complex concept of how do I change my product mix, my direction to the market on a global basis for almost every company. And so we not only have our outward-facing R&D that's developed for both the U.S., for both Europe, for both Brazil, both China, but more importantly, I now have inward-facing. I might have R&D in Brazil for my operations in Europe. I might have R&D in China for my operations in the U.S. And so research and development, as in and of itself, more is not better. In R&D today, better is better. And what that means is the output, the number of new inventions per R&D expenditure. Just having a 10% R&D load, that was the percentage that both Mr. Hewlett and Packard said was what you needed to do to be successful. Those guys made that number up back in the 30s and 40s, and literally everybody has hewed to that mark. And yet, there was no logical reason for that. As a matter of fact, as HP got bigger, they abandoned the 10%. So, great R&D, more is better, but getting from okay to great R&D, that's the goal. How do you link those? How do you make them more effective? How do you help them talk to each other? How do you create a global R&D group so that 24 hours a day, your one idea is working its way around the world so that when you come in the next morning, you're on day 4 of that R&D because 2 other time zones have put in 8 hours a day to move that project forward.
And lastly, when analyzing income statements, how important is it to reconcile those or to also focus on the financial incentives for senior executives that are outlined in a 10K?
Well, as everybody knows, first of all, this is a good topic, and it's one I always like. Now, the problem is it's not in the 10K, so you're going to have a hard time finding that. What you want to do is you want to look in the proxy to find the executive metrics. Then once you've found that, then you begin to take a look back to the income statement, occasionally the balance sheet, and how do I positively influence my portion? I don't expect you to run my whole company. My portion of the income statement such that I can say, and thus here is how it affects these metrics. Those metrics being those executive compensations you find in the proxy.
Jim, I'm going to throw a curveball at you and give you one last one, as it really is an important topic. A number of questions, people, again, looking for clarification on terminology. For example, EBITDA, net income, operating income, questions around what is the truest measure of the health of one of my customers?
Long-term operating income is the truest measure. What operating income is all the costs that it takes to run my company, subtracted from all the revenue I've received. It does not include interest and taxes. Now, EBITDA, earnings before interest, taxes, depreciation, amortization, that was invented effectively by the cell phone business back when they couldn't find a positive number. Last year we sold $7 billion on an operating basis. We lost $12 billion. Well, that's a horrible thing to say to people. Or, gee, this is getting greater. We only lost $6 billion this year versus $8 billion. So they began to start subtracting things from that loss until they could find a positive number. And that became before interest, pull that out, taxes, pull that out, depreciation of all those cell towers and those central offices, pull that out, amortization of all the software, pull that out. Ah, there's a positive number. Does your customer have to replace its machinery? If it does, then depreciation is real. Amortization, does your customer have to replace their software? In which case, it's real. Now, for an investor, probably net profit and cash flow are the two most important things because long term, that's what's important to you. But for everyone on this call, the number one item you want to go down to is operating profit and stop. Unless you have an income tax firm, unless you've got a interest reduction firm, and to be honest with you, in this day and age, the cost of interest for everybody but bad countries is quite low. Stick with operating profit.
Jim, thank you for a most informative session here today, and all of you who are still on the line, thank you for joining with us and staying with us for well after the top of the hour. This concludes today's presentation.